Hi everyone, Mike Johnston with US Invoice Funding. Say the first three videos in the series Business Made Simple outline the basics of understanding your business and how to treat costs to assure a profit. Within those videos, we created simple ratios, rules if you will, to generate a successful pricing formula. However, you may be thinking, well, I understand the formulas, but my business is a bit more complicated than that. How do I begin without screwing it all up? Before we go any further, I'm going to assume your company is over 1 year old. If not, check out our video on launching your new business properly. First, let's review the last 6 months and quantify the three major categories: gross earnings, cost of goods sold, and G&A. Make sure you earmark an appropriate amount of salary for yourself and add that to G&A. Now subtract COGS, cost of goods sold, and G&A from the gross earnings, and let's take a look at what we got. Is there any money left over? Well, if so, you're profitable. And does it equal 10%? I'm going to assume that answer is no, and that's why you're here. Over the years, I've launched multiple businesses, including manufacturing, distribution, and specialty contracting. Also at USIF, we analyze new clients daily. Therefore, our sample size is extensive, and we have witnessed benchmark ratios that dictate success. The following are general ratios that will produce profit. The first is simple, and it's very straightforward. Cost of goods sold and G&A cannot exceed gross times 90%. The second one, typically cost of goods sold should not exceed 75% if you're using subcontractors for the services that you're providing. The third one, typically if you're self-contained, should not exceed 65%. When I say self-contained, that means you're building your product, providing your service with W-2 employees. However, starting at 40%, as material makes up a greater proportion of invoices, cost of goods sold can inch up towards 75%. The fourth one, G&A should not exceed 20% of gross earnings. 15 to 18% is a good target. Okay, let's use these four benchmarks for you to get started. Well, number one, of course, is easy. You want to make a profit. We're aiming for 10% at least here. Number two, you coordinate and you oversee others to provide your service. Well, good. That means your business model should have a lean overhead burden, and you should have little need for brick and mortar space, employee health insurance, HR department. However, you are going to need to have a laser focus on your AP and AR, and also G&A should not exceed 15%. Number three, well, this profile might indicate that you're a manufacturer or a specialty contractor. Regardless, you're providing the product in-house. And if so, you have to be competitive. That means you have to be able to provide that product for less than you can buy it from a subcontractor or a subcontract supplier. Why? Well, for one, your G&A is going to be higher. Number four, a 20% G&A should cover any established business. If yours is more, you really need to scrutinize it. Most likely your company will be similar to number two or number three. Once you determine where your company fits, you can compare our expense ratios with yours, and accordingly, you can quickly determine where you need to make changes. Changing course is not easy. It requires that you seriously analyze your operations and determine which changes are necessary and which are doable. We work with clients all the time, helping them make adjustments. If you'd like our opinion, give us a call. And remember, if business is going well but cash is tight, we can help. In the next videos, we're going to review business launch tactics and burn rate management. I'll see you there.